How's everybody doing today? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to look at an S&P Global Market Intelligence article about how banks are hoping for rate cuts, but at the same time, they are still relying very heavily on high rate CDs, but leaning toward the shorter term, 1 year and less. So let's take a look at this article we bring in. So this is called Depositories banking on rate cuts, but a growing number are still marketing high rate CDs. So even though interest rates appear to have peaked, many depositories continue to use 1 year certificates of deposit with relatively high rates to attract and retain customers. So the rates on high yield savings accounts have attracted attention from the press and consumers alike, and for good reason. Data shows that a fair portion of the annual percentage yields offered by banks and credit unions are far above the norm, but those institutions tend to be extreme outliers. A better bellwether of where depositories are competing heavily is deposit betas, and by that measure, 1 year CDs and premium money market accounts are the key focal points. A comparison of CD maturity shows that banks and credit unions are betting on the Federal Reserve lowering rates and have been for over a year by leading with higher rates on 1 year CD versus longer term products. So sharp increases in interest rates and regulators' focus on bank liquidity have put a premium on all deposits, but some deposit products have proven far more rate sensitive than others through the Fed's tightening cycle. 1 year CDs were among the products with the highest implied cumulative deposit betas since the Fed started hiking interest rates in March of 2022. The national average APY on a 1 year CD with a $100,000 investment minimum rose 184 basis points since March 4th of 2022, implying that 35% of the 525 basis point increase in the effective Fed funds rate flowed through to the APY. Premium money market accounts with large investment minimums were also in the top five, along with a 1 year fixed individual retirement account. So let's take a look at this chart here and what we're looking at. So for the podcast audience, we are looking at a chart called Deposit Products with the Highest and the Lowest Betas since the Federal Reserve began hiking rates. Now, deposit betas they kind of run in tandem with rates. So kind of for the most part, you have an implied cumulative deposit beta. So kind of like the higher, think of it, I guess, in a simplistic way, think of it like the higher the beta, the higher your funding cost, the more interest you're paying out. And as witnessed on this chart here. So when we look at like the 10 highest betas, so we have a premium money market, so 250,000 and over, which has an average US APY of 1.94%. And the change, and then there's a change in the average, 186 basis points, and that's coming in at a 35.4% beta, whereas a 1 year CD for $100,000 has an average APY of 2.02%, and that's coming in at 35. And then you have a 1 year CD of just 10,000 has an average yield of average APY of 1.93% and has a 33.5% beta. So if we look down at the bottom, the 10 lowest betas, so we have a money market account up to, basically we have the tiered money market accounts. So we have money market account, $2,500, money market account up to 10,000, money market up to 25, money market up to 50, and then money market up to 100. And we could see here that the APYs are, obviously, as you would imagine, for $2,500, you get an APY of 0.47%. For going all the way up to, for 100,000, you got a 0.96%. And then you see the corresponding betas, obviously much lower interest rates, much lower yield. Therefore, you have much lower deposit betas. We have on the $100,000 money market account, which is at an APY of 0.96%, we're at like a 16% beta. Whereas at the $2,500 money market account, we're at a 7.6% beta. So much, much lower. So again, one thing you can infer here is that basically banks are targeting certain things. They're looking for, they are looking for CDs and they're looking for money market, but they're also looking to pay up for higher amounts. Like they want, obviously they're looking for CDs up to 100,000, even more. They're looking for premium money markets up to, basically 100 to 250,000 in average deposits or greater. So they're looking for larger deposits that can basically move the needle. You know, they're paying up on those accounts to try to attract those things. But even so, you know, you get a 100,000, a 9 month, $100,000 CD has got an APY of 1.65%. A 6 month CD for 100,000 has got a 1.83%. So it's still, you know, not too shabby, and not too far off from the slightly higher premiums we're seeing there at the top. So let's go down here. So okay, in terms of maturity, banks and credit unions have tended to raise rates faster on shorter term products, particularly in the 6 to 12 month time horizon. The lone exception was the 1 month CD. The APY on 1 month, basically with a $100,000 minimum, for instance, has only ticked up by 32 basis points since the Fed started hiking rates. Yeah, I don't know anybody who gets a 1 month CD. I don't think I can't even say in my career I've ever sold or seen anybody sell a 1 month CD. That's kind of fascinating. Industry data shows how banks are using CDs to bolster their deposit funding as well. For the commercial banking industry, the ratio of CDs to total deposits rose to 15.5% in the first quarter of 2024 from 15.3% in the fourth quarter of 2023 and 14.5% in the third quarter of 2023. Further, the percentage of CDs repricing in 1 year relative to the commercial banking industry's total deposits continued to climb in the first quarter of 2024, rising to 13.2% from 12.9% sequentially, providing further indication that banks are concentrating their deposit bases in shorter term CD products. One of the most stark discrepancies between short term products and long term products is the rate on the 1 year CDs relative to longer term CDs. So in mid February 2023, a 1 year CD rate eclipsed the 3 year rate, and in early April of that year, it started trading above the 5 year rate. So the fact that 1 year CD rates are higher than the other longer term rates suggests that banks and credit unions anticipate interest rates will be lower in the next 12 months, which aligns with the futures market. So, very interesting. And then we have a chart here that basically says the U.S. average APY on a 1 year CD has been well above longer maturity CDs. And it shows basically a 1, 2, 3, 4, and a 5 year CD. And you can see the 1 year is way higher than the others. Just kind of analyze. So our analysis includes both credit unions and banks, as it is no secret that credit unions tend to offer higher rates than banks. The median and average APYs offered by credit unions were higher across nearly all products as of June 14th. Let's see here. And then we have another chart here. Growing number of banks, credit unions marketing 1 year CD above 4%. So, and there's a couple things on this chart here. So number of credit unions offering APY above 4% is the kind of green bar right there. And we can see we have kind of over a number of institutions, kind of about over 1,000, credit unions right now that are offering a, APY over 4%. Number of banks offering APY above 4% is probably it's below the credit unions. It's probably about 900 some odd banks. Percentage of total credit union deposits, and it's the red bar here, and it's obviously way high there, and the percentage of total bank deposits. So credit unions obviously rely much more on CDs than banks do. So as we go down here, let's see here. The number of credit unions and banks offering APYs above 4% continued to climb from the end of March 2024 to the middle of June, suggesting that depositories are increasingly willing to pay higher rates. But when one raises the threshold to 5%, it paints a different picture. The highest rate payers seem to be pulling back somewhat. The trend of more institutions offering upward of 5% reversed in the fourth quarter of 2023, which was the same point at which credit union and bank industry deposits began to grow again following several quarters of decline. Reduced need for funding is an important factor in institutions' decisions to rein in rates. Number of banks, credit unions marketing 1 year CD above 5% peaked at the end of December in 2023. And we're just looking at a chart here that basically shows that. And then what do we got here? Savings accounts, not the only products where banks and credit unions offer APIs far above normal. So you have, again, we're looking at a chart here that's kind of regular savings, interest checking, money market, liquid IRA. And then we got down more like the premium money markets. Again, and then it says here, just savings accounts are also particularly interesting because a handful of the banks offering the highest rates are relatively large institutions. 5 banks with over 100 billion in deposits, Goldman Sachs, Capital One, Ally, American Express, and Discover Bank, were all offering APYs above 4% as of June 14th, far exceeding the upper outlier threshold. Digital banks such as these have no branch footprint and can pass along those savings to customers in the form of higher rates. As such, we would expect them to be among the outliers, but in general, they are relatively unique institutions in the overall banking landscape. We view one-year CDs and premium money market accounts as the areas where the industry as a whole are competing the most aggressively on rates. So again, I think this was, again, I thought this was a very interesting article, very interesting analysis of kind of where things are at rate wise with banks. I mean, banks are obviously favoring, they're betting that interest rates are going to go down here in the next year. So they're basically putting more emphasis on 1 year and less products, looking at the premium money markets, looking at the 6 to 9 to 12-month CDs. That's where they're offering the best APYs right now. We've seen the APYs peak at just over 5% in the fourth quarter of last year and have now basically come down over the last 6 months. So, but again, we've also see, the bank's reliance on those high funding CDs has increased. So it has so while the yield has dropped a little bit, banks' reliance on those higher funding CDs and money markets has increased, meaning that the banks have to continue to increase their funding costs to fund those higher deposits. So again, it's really good to take a look at this. Like I've reported before in some past episodes, that there are a number of banks out there right now testing the waters in reducing some of the rates that they have out there, even on these shorter term, premium money markets and CDs. And it'll be interesting to see kind of what the reaction is in the market to that. Right now, I think a lot of places are in kind of the same area. I mean, like they said, you could go to Ally or American Express and you could potentially get, a rate that's in the high 4s or maybe the low 5s or whatever. It appears right now that's probably about the best that you can get at the moment, which again is not bad. It's just perfectly fine. But as banks try to come down, it'll be interesting to see, like, will the customers revolt a little bit, so to speak? Will they decide to say, hey, I'm gonna take that. I've got 100,000 sitting in a CD. The bank cut the rate back to 3%. And now, but I could still get 4% or 5% from American Express or whatever. Are they going to then take the deposit and go run to American Express? I don't know. It'll be interesting to see, kind of how that plays out over time. But anyway, hope you found this interesting. I will continue to keep everybody updated on this and let everybody know how the interest rates continue to fluctuate over the next 6 months as we have reached the halfway point in the year and continue to head toward the end of the year now. Like I said, so I'll keep everybody updated and just on how this plays out. But if you like this episode, please make sure to like, share, and subscribe. Please check out some of the other content on the channel. And as always, remember, we are on YouTube, Rumble, and all major podcast platforms. And I will see everybody again real soon. Thanks a lot.